Welcome to Earnings Central. In this video, we'll break down E2open's third quarter fiscal 2025 earnings. We'll cover key financial performance metrics and dig into insights from the earnings call. All right, let's go. Starting with top-line revenue, the original estimate for Q3 was $152.6 million. The company actually reported revenue of $151 million, missing expectations slightly by 1%. This quarterly revenue also marked a 3.5% decrease compared to the $156.4 million reported in the same quarter last year. Moving to adjusted earnings per share, the original estimate for Q3 was 5 cents. The company actually reported an EPS of 5 cents, which was right in line with expectations. However, this result reflects a 25% increase compared to the 4 cents per share reported in the same quarter last year. Now, let's dive into some additional performance metrics highlighted during the earnings call. First and foremost, E2open showed significant progress in their retention rates, with management highlighting that Q3 retention results met their internal targets and showed continued improvement from Q2. This is a crucial metric for any software company, as it directly impacts recurring revenue and growth. Speaking of revenue, the company's subscription revenue decline moderated significantly to just 0.6% year-over-year, showing improvement from previous quarters. This suggests that E2open's efforts to stabilize their core business are starting to bear fruit. On the cash front, E2open ended the quarter with a strong cash position of $151.2 million, representing an increase of $9 million from the previous quarter and up $40.9 million year-over-year. This demonstrates the company's ability to generate cash despite challenging conditions. However, it wasn't all positive news. Professional services revenue saw a significant decline of 20.4% year-over-year, impacted by several factors, including delayed subscription deal closures and the completion of several large projects in the previous quarter. Looking at profitability metrics, E2open maintained a healthy adjusted EBITDA margin of 35.3%, slightly up from 35.1% in the prior year quarter. This reflects their ongoing commitment to operational efficiency and cost management. The company expects to end the fiscal year with net leverage around 4.1x, which, while elevated, reflects their current focus on balancing growth investments with debt management. Now, let's shift focus to some of the key insights and takeaways from the earnings call. Perhaps most importantly, management believes they are past peak churn, which occurred in Q1 of fiscal year 2025. This is a critical inflection point for the company's growth trajectory. E2open also made significant changes to their executive team, including promoting Pawan Joshi to Chief Strategy Officer and bringing in Rachit Lohani as Chief Product and Technology Officer. These appointments signal a renewed focus on innovation and strategic growth initiatives. An interesting development is the increased customer interest driven by potential changes in U.S. trade policy. Management noted that customers are actively seeking solutions to help manage an increasingly complex global trade environment, creating new opportunities for E2open's logistics and global trade management applications. The company is also putting renewed focus on their mid-market strategy, bringing in new leadership and implementing a three-pronged approach focused on improving retention, leveraging existing products, and driving volume through targeted sales campaigns. One ongoing challenge is that large deals continue to have extended sales cycles. While this isn't getting worse, it's not improving either, as these transformational deals often require CEO-level approval and involve multiple stakeholders. Finally, E2open reported strong progress in their system integrator partnerships, with management highlighting increased strategic discussions and joint client initiatives. They're moving beyond traditional implementation partnerships to focus on broader supply chain transformation opportunities. Looking ahead, E2open appears to be making steady progress on their turnaround strategy, though challenges remain. The stabilization in retention rates and subscription revenue decline, combined with strategic leadership changes and partnership momentum, suggests the company is laying the groundwork for future growth. That wraps up our recap of E2open's third quarter fiscal 2025 earnings. If you found this recap helpful and want to stay on top of more earnings reports from other companies, don't forget to subscribe. We've got plenty more quick and easy breakdowns coming your way. from Earning Central.